Yes. So yesterday we looked at identifying the scope, right? In whether an M&E group would come into the ambit of Pillar 2 or not, and how would we check that whether it crosses 750 million euros or more in the last two out of the last four preceding years. Now, this chapter is all about identifying constituent entities. Okay, so basically, after this completing this chapter, you should be able to identify which entities within an M&E group qualify as constituent entities for group purpose. See, an M&E group has a lot of M&Es, right? Out of which M&E is the constituent entity is what we have to see. So this is what the whole basis of this chapter. So let's dive deep into it. And of course, the million-dollar question that comes to our mind is what is a constituent entity? Loosely, constituent entity is a part of M&E group, which who would also who would be tested whether they are paying 15% ETR or not. Okay. So the textbook definition is a constituent entity is any entity that is included in the consolidated financial statements of the M&E group plus any entity that is excluded solely due to size or materiality. So what they're trying to say is constituent entity is any entity that is included in the consolidated FS. Okay. Now in consolidation in IFRS 10, you know that there is materiality ground. So you can exclude certain entities based on materiality, but for pillar 2, they would also be counted as a constituent entity. Okay, just because it is excluded in consolidation doesn't mean it is not included in pillar. Is that point clear? Fantastic. So, how do you start the identification? So how do you identify constituent entities? So, basically, what would we do? We would just look at the group's consolidation schedule. Now, if you look at consolidated financial statements as per IFRS 10, you would typically find notes to consolidated statements. Okay, in the notes to consolidated statements, this what all entities are included in this consolidation would be given. So first look at that. In the consolidated FS, look at the notes to consolidated FS and see who are the entities that is consolidated for preparing this report. Right? That's how you have to start. Now you tell me, when IFRS excludes certain entities solely due to materiality concern, why are those included in globe calculations? When IFRS itself says some entities, even though they have more than 51% control or ownership, still they are excluded on materiality grounds. But globe rules actually include them. Now the reason is this is an important anti-avoidance feature. Now what they would do is some entities, some M&E groups, what they can do is they can hide, they can on the basis of materiality not consolidate certain M&Es which are in a no tax zone. Okay. Now in any example, now you would argue that it would be just one entity, right? I mean, one entity, even if it is in a no profit zone, its revenue would be very high, right? Because that is the one which has all the surplus profits included to save taxes. So how do you think that that would be not included on the grounds of materiality? My dear, they will not just incorporate one company for doing that, they will incorporate 200 or 300 companies. Okay. Add these entities with very minor profits, in a 0% jurisdiction. And that's done. We have groups, that we do, which have instead of one company, have 18 to 24 companies for some reason. Have you ever thought about it? They could have managed the whole thing in with just one company. We ourselves are doing for certain groups which have 24 companies in UAE, right? Instead of just one which can do all the functions that the 24 doesn't. Most of them are not there. So that is how, if you incorporate more companies, you can exclude these profit makers from coming into the consolidated financial statements on the ground of materiality. Is that clear? So that is why globe rule sales boss, we would also be even if you exclude based on materiality in consolidated FS as per IFRS 10, but still For globe rules, this will be included because this is basic salami effect at you know in process. We personally know certain groups which have 24. Well, we would also be thinking, why do you need 24 companies? You can just run with one company can do the same process. Why would you need 24 companies doing the same process? That's because that's tax planning to evade materiality. Are you getting it? Yes or no? I need a yes or no at this point of time. Now, which is that group? We can talk separately. Okay. Right. Is this clear? What is a constituent entity? Constituent entity is all the entities that is included in the consolidated financial statements, and including some entity which is excluded solely due to materiality grounds. Okay. Now, how do you identify step by step? The first thing is you have to obtain the consolidation schedule. Okay. So request like list of all entities in the consolidated FS, list of all entities excluded on materiality or size grounds, ownership percentage of each entity, and consolidation methods used. This consolidation schedule we need from the client to understand whether they are a constituent entity or not. Okay. Now we have to classify each entity. Now you see there are many types of things which goes into the consolidated FS. Now there is a fully consolidated subsidiary, right? More than 50% ownership, full consolidation. Correct. I mean, this is the basic thing that would be the kind of entity that would be available in a consolidated FS. It is a constituent entity. Okay. If it is proportionately consolidated, you might know joint arrangements. They go for proportionate consolidation. Joint arrangements are also a constituent. But if it is an equity method investing, you know what is an equity method and what is significant influence. So these kind of things, like these kind of entities would also be available in the consolidated financial statement. It won't be as a line by line consolidation, rather it would be added into the consolidated FS using equity method. Correct. These are not a constituent, and also those which are excluded on materiality concerns, which are below the consolidation threshold, they are also consolidation and constituent entity. Are you getting this? So the only entity which is not which you can find in a consolidated FS but which would be not a constituent entity is a associate. Okay. But there is one more thing, like, an associate, if it is a joint venture, meeting specific criteria, if it is a joint venture and if it is proportionately consolidated, then yes, it would again be a constituent entity. Are you getting this? Yeah. Okay. So let's move on. So you get the consolidation and you classify each entity. Now, there are a few things which will not be there in the consolidated FS. That is permanent establishment. Permanent establishments are also a constituent entity. Okay, now this is something that you will not get in the consolidated FS. For this, you have to look at the each entity's tax report. For example, let's say that there is a German entity. Okay, we are the MNE, the UPE is in UAE. Okay, one MNE is in Germany. Let's say, but Germany has two permanent establishments, one in France and one in Switzerland. Then these are three constituent entities. Okay, the subsidiary in Germany, the PE in France, and its PE in Switzerland are three entities, not one entity. Getting it? So permanent establishment should be a different constituent entity. Right now, how do you identify permanent establishment? PE for a globe enterprise exists if it is treated as PE under applicable tax treaty, or if the jurisdiction taxes the entity on a net basis. So either if it is a treaty based PE, Article 5, or it is treated as a PE, or it's taxed as a net basis. The branch or permanent establishment whatsoever is taxed in the other country on the net basis, then in such a situation, it is a permanent establishment. It is a separate constituent entity. Okay. Yeah. For each entity, you have to determine, does it have P's or are these P's reflected in the financial statements? Okay. So this is also one thing which we have to go a little beyond. Okay, this is P's won't be separately identified. Now you tell me what would be the rationale for treating PEs as a separate constituent entity. Now the question that I'm asking is, wouldn't this PEs, let's say that let's get some action. Yeah. So let's say what I'm trying to say here is this. So let's say that there is an MNE. Okay, this is the UPE. It is in UAE, and let's say that it has two subsidiaries, one in Germany and one in, let's say, case. Okay. Now this German one has three, permanent establishments. Or let's say it is just a branch. Okay, so German company has three permanent establishments, and let's say this is in Russia, this is in France, and this is in India. Hypothetical example. Okay. Now you tell me in this group how many constituent entities are there? Quickly on the chat. How many constituent entities are there? Everybody is saying six. How six? One, two, three, four, five, six. Absolutely. So there are six constituent entities, including the UP. Correct. Now, one person may easily ask you, boss, why would you need six? We only need three, right? Because these are end of the day the branches of this company. So in the financial statements of this company, these would be included. The figures of this would be included, right? That's what happens with the branch, right? Now, why do I need to show that as a separate thing? So the figures are already included here. Why would I need to consider this as a separate constituent entity? This is a question. Now tell. Did you understand my question? Because all these figures would be available here. Why would I need to kind of do once again for here? That is because, yeah, if somebody is typing something, you're welcome. Because they are in separate jurisdiction. That is fine. That is fine. I mean, it is a PE end of the day because we are consolidating everything, and the tax would be would be paid in each jurisdiction, right? So that income is already included here. So why would I need to kind of show one calculation there also? This is because yes, not separate ETR. See, ETR is what? Taxes paid divided by total income. See, taxes paid here would also be included in the covered taxes here. Divided by total income of this would also be included here. So it won't be a separate ETR, but you understood why it is not a separate. You can nod your head, like I can. So why is because that's how this. See, you have to understand that even though this is a tax framework, it is based on a treaty. It is assigned by 140 countries. Now let's say that Germany this entity has a presence in Russia. Its income is included here. Its taxes are also included here. Okay. But let's say if it is 6%, who will get to charge the remaining 9%? Germany only, right? There won't be equitable distribution between other countries. And that is the main context of pillar 2, that everywhere there should be 15% tax. It's not that one place it is 15% tax, but that it is shared among all the market economies. Correct. So even though Germany would have taxes paid in three entities, in including Germany, and also it would include all the income of these three branches, Germany would get the right to top up tax, which will not be agreeable with others. They will also say that no, 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 we will also need this cut. So to satisfy the treaty participants and also to kind of bring a ground level into things, it would be taxed in each jurisdiction. Okay, so that is why they have brought PE as a separate constituent entity. Are you getting the rationale? See, other signatories would not be happy if Germany is getting it. Should be equitably distributed. They are doing some economic activity here, so Russia also has the right to top up tax. FR also has the right to top up. I understand it is consolidated, but that won't suffice. Everywhere there should be a check that would give every end of the day we discussed that there are a lot of infrastructure projects which are missed, right? So this branch is operating in Russia because there is infrastructure in terms of roadways, internet connectivity, etc. And end of the day, Russia doesn't get a chance to have the top up tax. Is counterproductive to pillar. So that is why even PEs are included into as a constituent entity. Okay. Is it clear? Because it's not very, you will not find an explanation for it anywhere. It is a little technical. You have to kind of understand why. Okay. Okay. So that is the rationale for treating PEs as a separate constituent entity. So you have to see whether CEs include PEs also. And the fourth type of things are there are flow through entities also. What is a flow through entity? What is a flow through entity? Flow through entity is something that does not have a tax base in its own name. For example, it would not be taxed in its name. It is a transparent entity. It would be taxed in the name of its owners. Can you give me an example? Unincorporated partnerships, foundations, etc. So flow through entities are transparent. It is its income are taxed in the hands of owners rather than the entity. Okay. So this is kind of what we call as a pure transparent entity. What are the examples? Partnerships, LLC, certain trust and foundation. Right? Entity may exist for consolidation, but its taxes will be borne by owners. Now we will have a big doubt whether these are a constituent entity or not. MNE would also have foundations and unincorporated partnerships also, right? So are these constituent entities? Answer is yes, yes, and yes. Okay, just because its taxes are being paid by somebody else or it is a transparent entity does not exonerate it from pillar. Getting it? Yeah. Okay. Now let's do a simple case study. Okay, but before that, what did we learn? What are the types of permanent constituent entities? Any entity which is consolidated line by line or proportionately, or which is even dormant, or something which is even not considered for materiality concern. Those are all constituent entities, including PEs and flow through entities. Okay, only thing that is excluded is something which is there won't be any consolidation, but there would be what we call as equity method investing. Is the only thing which is not considered as a constituent entity. Right? With that background, let's tackle this problem. So this is a company. Okay, Stratos Group PLC. Now there are 52 entities across 12 jurisdictions, and they have given the annual report of this. You have to tell me whether this is a constituent entity or not. So Stratos Group PLC, UK. You can even nod your heads. I can see from here. Stratos Group PLC. It's the UP. Is it a constituent entity? Yes. Okay. SG Holdings Limited in UK, which is 100% owned by Stratos. It is used. We use full consolidation method. It does not have any PE. Is it a constituent entity? Absolutely. What about Germany? Same constituent entity or not? Yes. France also 100% owned by the UPE. It is using full consolidation. It has a PE also. Now, how many constituent entities are there in this row? There are two, because France SAS as a subsidiary which is following full consolidation is one constituent entity, and France's PE in Belgium is also a constituent. Okay. Now again, like PG Singapore is 100% owned and use full consolidation. It is a constituent entity. Ireland is also the same. Netherlands is also the same. Okay. USA is also the same. Australia is also the same. It's all uses full consolidation. We don't need to do. TechStart. TechStart Limited is also having 100%, but its consolidation only happens from July 2024. Is it a constituent entity? Absolutely yes, but it is a entity which has come in mid-year, right? So for 3750 purposes, we will only take the revenue from July 2020. Now, Asian JV Limited Hong Kong is what? Is it a constituent entity or not? No, because it is an equity method investing. I only have significant influence. So I will not be, and even if I have a PE, those will not be a constituent entity. What about SG pension trustees? It is excluded on materiality basis. It's not consolidated and might probably be a flow through entity. Is it a constituent entity or not? SG pension trustees. It may be a flow through entity. On top of that, it is excluded on materiality concerns. Is it a still? It is a constituent entity. Are you getting it? Like how different cases will come. Only the equity method investee will not be there. Now there are a few special cases which we have to understand. Entities joining mid-year, like we saw about TechStart, right? That's the name. Yeah, TechStart. Is it a constituent entity? Answer is yes, but it becomes a constituent entity only from the acquisition date. Okay. So for all purposes, for finding globe taxes and all, like, globe calculations, the entity, we will only take the post acquisition period. We'll come to globe calculations later, but you have to understand that when an entity joined mid year, we will only be taking its globe calculations, only taking the time from it joined for globe calculations. Okay. Yeah. Yeah. Techstart was acquired on 1st July. It is a constituent entity, but globe income and cover tax are calculated for the period 1st July to 31st December 24 only. Just for understanding, don't worry about globe income and cover taxes, what they are and all. We'll come to that later. But this is what happens to entities joining mid-year. Okay. Now, what about entities leaving mid-year? Same, we would only be using them for globe calculations till the disposal date. Okay, so let's say that instead of 1st July 24, this person disjointed from the group, then we will be including that for globe computations till 1st July. Okay, till 1st July, we will be looking if they have paid 15% ETR or not. Okay, what about dormant entities? So, what is dormant entity? Dormant entity is one which does not do any operation. It's kind of very dormant. No income, no expense, nothing. Right? We see a lot of these companies. Are they a constituent entity? Answer is yes. Dormant entities that remain in the consolidation schedule are constituent entities, even if they have no activity. They will typically qualify for de minimis exclusion, but will still be identified and okay. There is something called de minimis exclusion which will come later. We will look at that. But you have to understand that they are also a constituent entity. Dormant entities are a constituent entity, even if they don't have any income or expenses, and they are not paying 15%. That they have a point of topping. Okay, so dormant entities are also a constituent entity. Now, what about stapled structures? Now, what is a stapled structure? Does anybody have heard of staple structures? If not, we can move around. So staple structures are something like this. So what happens is these are generally two companies. Okay. So let's say that there is company one and there is company two. Okay. These are company one and company two. Now, these are separate legal entities. Okay. Company one is a separate LLC, company two is a separate. But let's say they do something like hotel business. Let's say, hypothetical example, hotel business, or like they are doing. See, what will happen is the assets, no? All the assets would be here. Okay. What are the assets that building company? It would definitely be the building, real estate, investment property, machinery. So all the furniture and fixtures would all be in this company. Okay, would all be in this company, but all the people, operations, billing, invoicing would be from this company. So basically, it means to say that this company and this company cannot coexist. Like cannot they have to coexist. They cannot be separate. The I can't operate without all the assets, and he can't operate without all the people billing and invoicing and operations. So this is called a staple structure. Okay, this particular framework of thing is called the staple structure. So what happens is normally you will find these staple structures everywhere. And what happens is even though they are two companies, their shareholding or their shares would be bundled. Okay, they would be bundled and they would be sold as one. So in case if they are going to list, okay, in a stock market, they will be bundled, stapled together, and they would be listed as one. So they would only have one share price. Okay, and if I pay this one stock price, I would be owning a stake in both the companies together because it's a stapled structure. One cannot exist without the other, and these are stapled together and sold in the stock market. Are you getting what is a staple structure? Yeah. So if it is a stapled structure, say there is company one and company two as MDs, right? And they are stapled. They only have one share price. They have same shareholders and directors and all, and they don't kind of subscribe into both of them separately. They subscribe into the structure. Okay, so in such a situation, if there are MNEs in the group which are like this, would they be counted as one constituent entity or two constituent? That is the question. Yeah. So let's see. So in a staple structure where two or more entities are contractually bound and traded as a single unit, the structure may constitute a single M&E group. Each stapled entity is a constituent. So that means in case if the M&E group is having such a structure, this is not one constituent entity, rather this is two constituent entities. Okay, company one and company two would be seen separately. Because this again becomes a tax avoidance mission. I will have company one which is having all the billing and invoicing in a low tax jurisdiction, and company two in a high tax jurisdiction, so that I can claim all the depreciation. Right. So to avoid all these kind of structuring, they say that company one and company two will not be seen together, rather it would be seen separately. Getting it? So this is a stapled structure, and this is what is there. Getting staple structure, it is not something that you're exposed to on a daily basis. Sorry, I have few chats. Okay. If this is clear, let's go ahead. Now, documentation requirements. Now, what documentation was needed to see whether it was in scope 750 million euros or not? We had a list. I hope you have noted it down. Else, I'll share this again. But for constituent entities, what are the documentation required? What are the things that you will be taking from the client? What are the things it would be there in the file? First thing is entity name. You have to have a constituent entity register. Okay, maintain a register which has an entity name, jurisdiction. Okay, where is the country of tax residence? Entity identifier, local registration number, if available. Ownership percentage and how it is consolidated, full, proportional, equity, or excluded. Because constituent entity classification, whether it is yes or no. Classification rationale, a brief description. Effective date, when you would be including it in the globe calculations, and whether it is a PE, and you have to review and update this register. So this is what top tax firms do. Okay, they have documentation, they have a register for everything in respect of every client. Okay, so first I told you how to identify what are the documents you have to take from the client to identify whether you are coming in scope, that is 750 million euros or above. And second thing is, like, while understanding if each entity is a constituent entity, you have to kind of like take these information and maintain a register. This is what professionally you have to execute such work. Okay, is it clear? Okay, now I will ask a rapid fire. What are constituent entities basically? So constituent entities are those entities which are included in the consolidated financial statements. Okay, now and on those which I would be doing the growth calculation, right? So each constituent entity means each one has to satisfy 15% ETR, right? That is the thumb rule. Now you tell me, if I ignore certain constituent entities which is not there in the consolidated FS due to materiality thresholds, should I include them as CEs? Answer is yes, right? Even if it is materiality threshold. I told you an example of one of our dear companies which has 20, or one of our dear groups which are 24 companies in UAE instead of one doing the same operation. Why? That is the structuring they can do if we ignore things on materiality basis. That's number one. Number two, if I have a dormant entity, would it be a constituent entity? Answer is yes. If I have if I have MNEs which are joint ventures, full consolidation, they would all be CEs. But those MNEs which are equity investee will not be a constituent entity. And in case of stapled structures, even though there are two companies, one structure for two companies, it would be seen as two constituent entities. Okay. And one more thing which we saw was flow through entities. Flow through entities, basically transparent entities where tax is paid by the owners. They are also a constituent entity. Okay. So you can ask me, if it is a flow through entity and if it has paid only 6% ETR, how will it pay the remaining 9% ETR? Who will pay? Again, that payment will be made by the owners itself. It won't be paid by the company because it does not have a separate legal entity. Okay. Same way of payment, but they would also be a constituent entity. If we exclude such guys, then you will see a lot of incorporate partnerships there or foundations there, because it becomes a free, easy way to evade taxes. So this is all about constituent entities. Tomorrow we will look at parent company and determination of UP. We'll go into much more bigger topics like UPE, as well as intermediate parent company, IPE, what it means, how these are going to be very important in growth calculations, and what are our deal with all these. So we will continue tomorrow. If you're okay with who the constituent entities are, so basically in 2 days we have just done only, like, one, how to identify the scope, and second, how to identify the constituent entities. Okay, we will go, and tomorrow we will look at how to determine the UP. Normally determination of UP is easy, but in some structures even UP determination is very hard. So we will look at, like, what are the guidelines and ground rules to identify the UP, and if, and also the intermediate parent company, how it is important in growth calculations. Okay, so Poodles will see you tomorrow. Okay.